Hey champ, it's Nicholas Puri here. Don't adjust your screen. This is a whiteboard, it's meant to be blank. So today we're going to be doing our lesson based on this whiteboard. The reason is that unfortunately our lighting equipment is bust and we need to get some new lighting equipment. So while we're waiting for that to arrive, I thought I don't want to miss out on the lessons that we have planned, so let's use this whiteboard thing for a change. So bear with me, it's the first time I'm using it as well. And today we're going to be talking about position sizing. I want to talk about how we decide on the different position size that we use for each trade and the difference between a probe trade and a full trade and that kind of thing. So the first thing I want to start off with is to explain the difference between dynamic and static position sizing, just really quickly. So static position sizing, static, is where you might say something along the lines of, okay, for every £3,000 in my account, I'm going to open one contract. So what this would mean is that if you have, say, £9,000 in your account, then you'd obviously open a trade with 3 contracts and so on. Now, the problem with this is that you're not really managing your risk properly. You're basing your contract size on the amount in your account, but not on the trade itself. So certain trades will be more risky than others. Some might need a wider stop loss than others, and each time you're risking the same amount. So if you've got 3 contracts and you've got a stop loss that's 10 pips away, maybe that's 1% of your account, and maybe if there's 30 pips that's needed for a stop loss, using the same contract size, it might be 3%. So obviously in these situations, if you're using the static amount, you're not really factoring in the fact that there might be a difference in risk in the setup and that you might need different position size. So that's the static stop loss. And then the alternative that we prefer to use is something called a dynamic stop loss. Now, I've spoken about this before on the channel, so I'm not going to explain the full calculation. If you search for how to open a forex trade, I think that's what the video is called that we've got out. It's sort of explaining this. But in this situation, what you do is you sort of decide where the stop loss is going. So let's say that your trade's being opened there, your stop loss is going to be here, and this whole size here is, say, 20 pips. You then figure out the percentage of your account you want to have at risk, and that percentage is going to be based on the overall setup. So what's going on here to sort of create that setup where you're opening the trade. That's like a little face, so I'm going to draw the face in because you know I like to... oh god. So that might be 20 pips. So you're then calculating from the stop loss stat, you might want 1% of your account at risk based on the overall riskiness of this face. So you're figuring out how much per pip you can put on, and you're figuring out how many contracts you can open based on that. So that's more dynamic because it's sort of depending on the positions, on the overall setup rather than your overall account size. So what I want to talk about today is using a dynamic approach, but in particular it's not talking about this sort of where the stop loss is or anything like that, because that's determined by the setup itself. It's deciding this part, the percentage that we have at risk. So let's get into that. Let me first of all clear this background. We don't want that face anymore. So I always think of your sort of position size as a bucket. So imagine you've got different buckets here. These are beautifully drawn buckets. Definitely not going to have any problems with leakages, especially not this one and this one. Anyway, these are our buckets with the little handles there. Now the different buckets have different sizes, and each of these buckets obviously have a maximum capacity. So for example, if the bucket over here is filled up to the top, and this one's filled up to the top, this one obviously has more water in it than this one. However, this one, if it's filled up to here, the bucket, if it was at full capacity, might be bigger than these two, but filled up to here, it's less than both, or maybe equal to this one. So, where am I going with this? Basically, with trades, each setup that we have has an overall bucket size, right? So, obviously, with the way that we approach our trades, I know some of you watching this might have different strategies that you use, so you can this is still applicable to the way that you might want to trade as well. But for us, we're looking for double confirmation. What we mean by that is that you're getting sort of a setup, an entry confirmation from 2 different tools at the same time. So with these different tools, obviously each tool that we have different levels of strength, And by strength, we mean two things. We mean, one is dependability. So we put depend. And two is the actual size of the move it's going to generate. Sorry, that depends a bit laggy compared to what I'm writing. Size of move. So this means that one is, with the dependability, it's going to be, like last week I discussed the certainty level of the trade. So if a tool is more dependable, there's less uncertainty when you enter. So for example, let's say that is a level and you're expecting it to reverse. The dependability is that sort of more times out of 10, like compared to something else relative, it's going to be actually creating the reversal that you expect to happen. Now the size of move is that obviously a level might have a move that's this size, so it's been dependable, like 9 times out of 10, it might do this off the level each time, maybe up like this at that time and a tiny bit like this, but 9 times out of 10 it's doing that as opposed to breaking straight through. However, this level, the dependability might be lower, so it might be that this time it's 6 times out of 10. However, when it does come off the line, it's having much bigger size of move. So it's a combination of these 2 points that help us determine how laggy that pen is. that helps us to determine the overall strength of a level. So since we're looking for a double confirmation, you've got 2 possible levels that have strength. So you can imagine that when you've determined like all of the different tools that you have in your arsenal, so it's sort of like the different clubs in your golf bag. So let's say there's, how many of them? 5 of them. 1, 2, 3, 4, 5. Yep. What you could do is rank them. So obviously you're not everything's so clear cut and so binary that you can rank everything so perfectly. But imagine that you've got your tools here and you've maybe got tool number or tool A, you've got tool B, you've got tool D, tool C is over here, and tool E is here. So you rank them based on a strength. So this one's going to be maybe the strongest because it's the most dependable, the size moves better, and so on until you get down to this one, which is the weakest. However, since we're looking for double confirmation, then you're going to be taking 2 of these to create your sort of situation. So, for example, if you have an A plus E, that is a plus sign there, it might overall equal, well, 1 plus 5, or maybe it should be the other way around, that this gets 10 out of 10 and this gets like a 1 out of 10, that together they're an 11, whereas maybe this one is going to get like a 9 out of 10 combined with that one, so A plus C maybe is actually like a 3 out of 10, so you've got a, what did I say, an 8 out of 10, a 3 out of 10, so maybe this equals 11 as well, that was a B. Okay, I think you're following what I'm saying. It's quite clear so far, I think, or maybe not so clear the way I'm explaining it, but it's quite an easy concept to understand. Is that you've got your tools ranked and you're looking for double confirmation, so they each have different strengths. Now, obviously, with each of the different tools, they're not consistent all the time. Sometimes there'll be certain setups for a tool that look better than others. So, for example, when we're looking at our Fibonacci and we're looking for our A, B, C, D, we could have A, B, C that's like this, and the D is where we're going to trade, or we could have one that's like this, where you're going all around the houses with your C point until you get there. Now obviously the difference between these is that this one's going to be stronger than this one, but you can still trade it, but it's going to be further down the league table. So this is why I said it's not necessarily set in stone. You can't have just one league table for all your different tools that you're going to bear in mind. That you can like use for certain each time. It's just something you have to bear in mind overall. So it's part of a decision making process that you're going to make. So based on that, based on the different combinations you can have, you might have then different sizes of buckets. So for example, A and E might end up with this bucket here, this size, whereas A and B, which are both 2 of the strongest ones, will be this bucket here. And if you have C and E, then maybe it's like this little thimble over here, not even a full bucket of water, it's just a little thimble, which I'm going to fill in now with a huge line like this, look. Oh, I don't even know what's going on here. I have no idea what this pen tool's doing, but we'll figure it out as we go along. So I think I've adjusted the pen size, the brush size. Alright, so getting back to this now. So based on the combination you have a different bucket size. right? So let's now switch to a blank screen and talk about one specific bucket. So let's say we have tool A and tool D, and the bucket size is this. It's so laggy, this pen. I'm going to have to figure out a new way of doing this for if we do this in future. I can't tell where I'm drawing, so we've ended up with something that looks like Towley from South Park. Anyway, let's say that this full bucket, based on A and D, I think it was, that full bucket is going to give us a maximum of 1.3% at risk per trade. So I always say, and I suggest you stick to this, that for most people, the very, very maximum you ever want to put on a trade is between 1 and 2%. So it depends on you what your risk tolerance is. So based on that, if the maximum that you ever want to put on is 2%, that means that the very, very the strongest possible combination that you could ever have is going to give you a maximum of 2% in the bucket. So since this one's A and D, you may be getting 1.3% in this case. So that means if the bucket's completely full, we're going to have 1.3 from the combination of those two. Now we need to start to think about the context of the situation, start to determine exactly how much of that bucket is going to be full. So for example, like I said, with the tools, you have different situations with them where sometimes they react better than other times. Sometimes they're more dependable than other times, depends on the context of the market. So let's just assume that they are as strong as they could possibly be, the combination of the two. So that's one thing, which is the setup. So let's go over here and write the things that we're looking for. So the first thing is that we are looking at, one second, get a black pen. One is the setup. That's the combination of the two things that we've used for a double confirmation. You can have more than two, you can have however many you want, but let's say that's the setup, that's the first point we're looking at. The next thing, number two, is that we want to consider the structure of the market. And what I mean by this is that, are you going with the trend? Are you going against the trend? Is it a reversal? Is it a breakout? How far into the trend are you? Are you close to the higher low, the higher high? You have to assess where in that structure you are and whether that structure is strong and on your side. So that's the second thing to consider. The third thing to consider is the path of resistance. So the path of res. So when we consider the path of resistance, is there a major significant level straight away above your entry point when you're going long that's going to disrupts the sort of path of the price that you want it to move in? Is there, is the TMP too close and all that kind of thing? You might, or is there a potential TMP that's too close where the structure's against you, there's path of resistance in front of you? Basically, all the different significant levels in the market are creating paths of resistance, or are adding obstacles to the chart, and the price always wants to move in the path of least resistance, so it's going to move in the path where there's least obstacles in the way. But obviously the different obstacles have different strengths, as we just discussed, so we want to assess that. So based on those, you can start to determine how much the bucket gets full up. And this is just on a basic level, because there's other things to consider as well. So let's say that based on all of these, we decide that it's just above half. I am really trying to draw in the lines, but it's lagging so much. And let's go back to our pen. Let's say based on that, it's about just over half, and let's say that it's 0.7% of our account at risk. So based on these factors over here, we get this 0.7%. So how now can we increase this or reduce it? So remember, we spoke about wanting to reduce uncertainty. So the reason it's at 0.7 now instead of 1.3% is because there is some uncertainty based on these factors here. Okay, so now to decrease the uncertainty, we can use our negative filters. So let's say that we've looked at our negative filters that we discussed in a video last week, and based on that, we can now bring it up to here. Okay, so based on the negative filters that we just analyzed, we can now bring the overall position size up to, let's say, 0.9%. So 0.9% of the account at risk based on these factors, based on the overall setup we discussed, and based on the filters which are reducing the uncertainty, and as a result of reducing the uncertainty, it's increasing the position size. Now, we need to also consider what's going on from the fundamental point of view. Now, I've already decided ahead of time with my trades my sort of fundamental bias at that point in time, what I think is the state of the market at that point, and I assess whether I want to filter certain directions. For example, I might think that over the long term, Euro is going long based on a certain decision. I don't want to go short on Euro. So if there's a short opportunity, I straight away want to have a smaller bucket. Or, I might decide that if I'm going to be entering a trade, I'll be in and out quickly because of certain things that are coming up. And another thing to consider is the economic releases. So I wrote an article for bullbearings.co.uk, the stock exchange website, or the fantasy stock website, I think it's called. And it's quite a famous one, actually. It's one of the ones that years and years ago I opened a demo account with when I had a stock portfolio when I was at university. So I wrote an article for them, and it was about how we can sort of reduce the impact of economic news on our trading. And part of that, again, was creating that league table, but this time of having a league table of the potential news releases. So obviously NFP is going to be highly volatile, whereas something like maybe trade balance is not going to be. On the other hand, sometimes certain news releases can be more or less volatile than normal based on the expectations or the significance at that point in time. So it's something that needs to be adjusted regularly by having a look at the calendar for that week and making a judgment. You don't necessarily have to have league tables, all of this stuff. I'm not saying start an Excel sheet where you're having league tables that you adjust all the time, although if you want to and it's going to assist you, do that. But it's more of like a judgment you have to make at that point in time, and this is where there's a bit of a grey area and it's a bit creative, and you have to use your initiative a little bit with the overall trade position size. But let's say that you look at the overall thing, the overall league table for the economic releases, and from that you can determine that actually there's a news release coming out quite soon, just after your entry, and it's the where it's positioned in your league table is telling you that you want to have only a maximum of let's say 70% of your position size or something like that. So just to keep things simple, let's say that was 1%, so I don't have to figure things out off the top of my head. Oh look, I'm revealing the transparent background. That's useful, isn't it? So ignore that. Anyway, let's say that I've now cleared and it's down to say 70% like we were saying before. So I can fill that up a little bit more just to make it a little bit more accurate. So let's say, oh dear, what am I doing? I'm making a mess of this. See, I told you guys, you have to bear with me with this. Anyway, so let's say that it's up to here, and that leaves us with back to 0.7% of the account. So from our starting point of just finding a setup, we've now, with our dynamic position size, we've now taken into account the overall context of the situation, and we've decided on our position size overall based on everything that's going on. So this is just broadly the sort of things that I want to determine for deciding my position size. And this is really important because a lot of people sort of don't consider how important a position size is. So for example, people want to increase the number of trades they can open. By doing so, let's say that each of your trades is going to make you 1%. Let's say you open 3 trades instead of 1 and they all make a profit, so you make 3%. Okay, fair enough. But what if you could actually take one of those trades, and by using your filters that increase your certainty, by adjusting the position size, you could actually increase the amount that you have at risk in each trade, and therefore increase the potential profit you can make, and maybe one of those trades ends up making 2% instead of 1%. And on the other hand, let's say with your losses, by doing this in the situations where it's more risky, you've actually reduced your position size and it's been effective. So when you've made a loss, instead of losing maybe 1%, you've lost 0.7%. So over time, this accumulates, because in the same way that instead of making a 1% loss, you've only made a 0.7% loss, that is the equivalent of losing 1% and making 0.3%. Or even when you talk about bigger amounts, then it's even more that it's like you're making, because you're saving yourself the effort of having to, make back money on a smaller account size. But that's something for another day to discuss. Anyway, so now we know that based on this overall maximum that we would have allowed of 1.3%, we have a position size that's about half of that of 0.7%. Now, we have something that we call a probe trade, and we have something that we call a full trade. So you watching this now, have a guess. This is 1.3%, is the maximum that we'll allow for this trade, and we've decided on 0.7%. Do you think this is a full trade or a probe trade? A full trade or a probe trade? Well, you probably should have gone for this answer here, a probe trade, but the correct answer is this is a full trade. You see, from this overall scenario, we're saying that the maximum we can trade based on all these factors that we've determined is 0.7%. So in this situation, the full trade is 0.7%. So what's a probe trade? Well, a probe trade is in situations when you don't necessarily want to enter your full amount into the trade first of all. Let's say, for example, you're entering a trade at this level here to go long, so you want to go up that way, but there's a major significant level just below it, and since you know that significant levels attract and repel the price, it means that when the price is here, there's a chance it could be attracted down to this one. So at this point where you could enter, where you get a setup, you might decide to open a probe trade, and you might decide that's going to be half of your full trade. So if your full trade is going to be 0.7%, your probe trade at this point might be 0.35%. Okay, sorry that that's not clear there. And what in this case, what will happen is if this trade does go long at that point, like you kind of want it to, then fair enough, you've only got a probe trade of 0.35%. However, if it goes against you and does create a setup, and only if it does create a setup, these are the only occasions where I'll ever scale into a losing trade, and I'll add the other 0.35% there. Alternatively, it might be a situation where you're not 100% convinced. Maybe it's a situation where, for example, you're trading a reversal, so the price has come down like this, and the trend's against you, and you've got a small position size, but at the same time, you only want a probe trade. So in this situation, what you might do is enter your 0.35%, for example, and wait for there to be a new high created from this level here, so a higher high and a higher low, and you might at this low where there's a pullback scale in with your next 0.35%. So we'll talk in more detail about scaling in another time, but I just wanted to point out that that is the difference between the full trade and the probe trade. There's a difference between a small full trade and a probe trade, because you can have a small full trade and your probe trade of that full trade will be smaller. So your probe trade's like the little group that you send in first before the full army goes in, right? It's the way that I think about it sometimes. So it might seem like a lot of work, and probably in the comment section we'll get people saying that, oh, this is just too much, no one needs to do this, no traders do this. But if you think about it logically, because I always like to bring things back to logic, I don't like to do things for the sake of it, everything has to tie together, that when you think about this logically, like I said over here, I'm sure many traders are willing to put in time and effort to find extra trade entries or to find more certain trade entries. So why would you not also try and manage your position size effectively to make sure that you're not only maximizing your profit, but you're also minimizing your potential loss in the risky situations. So your risk and return is fluctuating depending on the overall situation and the context, taking into account a lot of different factors. So guys, I know it's quite a lot to sort of take in if you haven't gone through this stuff before, but I think that, you know, if you start looking into this and start trying to incorporate it, ask as many questions as you need, then it can really make a big impact. This can be the difference between having an average P&L for a year and having an amazing P&L because you've really managed all factors of your trading. A lot of people focus a lot on the trade entries, but believe me, your trade entries is only a very small part of the overall equation. The position size is just as important, and also your trade management and how you exit. So the risk is very important. Your discipline in sort of going through those calculations is important. Discipline is not just about having the patience to execute your plan properly. It's also about having the discipline to work through all of these calculations and stuff like that seems tedious. And that's it really, and then the exit plan. So we'll go through all of these different components as well in more detail, but I think this is probably the first time that I've explained position size in this much detail on this channel, and I think this is a topic that we'll probably have to cover a few more times so that it really gets embedded in your minds and you can start to use it. I hope this has been useful for you so far today, and don't forget, that if you like this video, hit the thumbs up button. Don't forget to subscribe if you haven't already. I don't know why my writing's gone all like that. Subscribe, thumbs up, and I'll see you in the next video very soon. Take care, guys. Bye bye.